I've said it before, and I'll say it again, trading isn't about catching every tick or guessing what happens tomorrow. It's about understanding the rhythm of the market, the points where it holds firm, and the places where it breaks down. That's why today I want to speak to you about the hidden power of support and resistance. And it ties right into what we covered in the previous video on the rule that helps you catch big moves. Because without understanding where the market digs in and where it surrenders, you'll never have the nerve or the patience to hold for those big swings. Now, let me tell you something from experience. Prices don't move in a straight line. They surge, they pause, they retreat, they test. You've seen it on the tape. A stock climbs to a certain level, hesitates, pulls back, and then either pushes through or collapses. That hesitation, that line in the sand, that's what we're talking about when we say support and resistance. And here's the funny thing. Those levels are as much psychological as they are technical. They exist because traders believe they exist. Do you see the irony? The market is nothing more than a crowd of opinions, money, and fear, all painted in numbers on the tape. Let me ask you this, have you ever bought a stock, right, where you thought it was safe, only to watch it break through that so-called safety line and punish you? That's the danger of not respecting these levels. Support isn't a guarantee. Resistance isn't an iron ceiling. They're points of decision, places where the market shows its hand if you're patient enough to wait for the reveal. I remember plenty of times when I sat watching a stock hammer against the same number day after day. The amateurs said, "It won't go higher, it's too expensive," but the tape kept showing buying pressure. The bids held, the offers got eaten up. That ceiling that looked so firm to the crowd. To me, it looked like a door about to break off its hinges, and sure enough, once it went through, it shot up like a powder keg. Why? Because resistance isn't just a price. It's a trap for the shorts, and once that trap is sprung, they scramble to cover, fueling the very move they thought impossible. But don't think support and resistance are only about breakouts. No, the smarter game is to watch how price behaves around those levels. That's where the truth lies. Does the market respect the floor? Do buyers step in with conviction? Or do they test it weakly, showing fear and hesitation? That's the clue. That's the signal. And if you're sharp, you'll recognize when the market is telling you it's about to reward patience or punish stubbornness. Let me pause here and ask you, do you see how these levels aren't magic lines but living battlegrounds between bulls and bears? Too many traders think drawing a line on a chart gives them an advantage. It doesn't. It's how you read the behavior at those lines that gives you the edge. The tape doesn't lie, but your interpretation can. There's a wealth principle buried in this idea. Wealth doesn't come from constant action. It comes from discipline, from waiting for the fat pitch, as some call it. If you chase every swing, you'll bleed yourself to death in commissions and small losses. But if you can wait for the market to come into your zone, the level where support or resistance is tested, you shift the odds in your favor. And isn't that what trading really is? Not certainty, but probability stacked your way. Think back for a moment. Remember when we talked about the rule that helps you catch big moves? The same patience required to ride a trend is required to let support or resistance prove itself. One without the other is half a strategy. Together, they form the whole, because it's no good to hold a stock for a big move if you don't know when that move is valid and when it's a false start. Now let's talk psychology, because support and resistance live as much in your head as they do on the chart. When a stock hits support, what happens? Traders who bought lower start telling themselves, if it breaks this, I'm out. That creates a pocket of fear, a cluster of stop-loss orders waiting to be triggered. On the other side, value hunters are saying, this is cheap, I'll buy here. That creates a pool of demand. So, the level becomes a zone of tension, a tug of war. Whichever side has more conviction wins, and the loser fuels the winner's victory. That's the hidden power. And resistance. That's the mirror image. Imagine a stock climbing back toward an old high. Traders who bought at the top months ago, and suffered through a long decline, finally see their price again. Relief floods them. They sell just to get out even. At the same time, momentum players are piling in, saying, if it breaks out, I want a piece. Again, tension builds. Do you see the recurring theme? Support and resistance are the crowd's memory etched into the chart. I'll tell you another thing. The best trades come not from guessing, but from watching the behavior when those memories are tested. Do you notice how the volume swells when a level is attacked? Do you notice how quickly or how slowly the price reacts? Those are your clues. The crowd tips its hand in the heat of the moment. All you have to do is sit still, observe, and act when the probabilities tilt far enough in your favor. Do you ever feel restless when the market is quiet, as though you should be doing something? That's where most traders fail. They act because they're bored, not because the market is giving them a signal. But the professional waits. He knows that every wasted trade eats into his mental capital, not just his financial account. And believe me, mental capital is harder to replenish than dollars. When you blow your discipline, you're no longer fit to read the tape. That's why support and resistance are gifts, natural checkpoints that tell you when it's worth risking your money and when it's not. Now, let's dive deeper. Support isn't always horizontal. Sometimes it's a rising line where the stock respects an uptrend. Each dip gets bought higher than the last. That tells you the buyers are growing stronger, the demand is persistent. The same applies in reverse for resistance on a downtrend. Each rally peaks lower than the one before. That's the market whispering, don't be fooled. The path of least resistance is still down. Do you catch that subtlety? It's not just where the line sits, but the slope of the line that matters. There's another thing I want you to understand. The market loves to fool the most people it can. Ever notice how a stock will break a support line by a few points, trigger the stops, scare the weak hands, and then bounce back violently? That's no accident. That's the professionals shaking out the amateurs. If you let yourself be part of that crowd, you'll always be on the wrong side of the move. But if you train your eye to recognize the fake breaks, the false moves, you'll see opportunity where others see disaster. And let me ask you, do you think those false breaks happen by chance? No, they happen because fear and greed are predictable. The crowd behaves the same way today as it did 100 years ago when I was trading in bucket shops. Human nature hasn't changed. Only the tickers and the screens have changed. Support and resistance were real then, and they're real now because the emotions behind them are eternal. But don't misunderstand me. I'm not saying you should buy every dip at support or sell every rally at resistance. That's the amateur's game. The professional waits for confirmation. He looks for the market to prove itself. A support level tested and held multiple times grows stronger until it finally breaks. And when it breaks, the fall is sharper because everyone believed it would hold. That's the trap. That's where fortunes are lost and made. Think about it. Isn't the richest lesson here about patience and timing? Wealth is built by those who can wait for the right setup and strike with size when the odds favor them. Not by those who nibble at every shadow. Support and resistance teach you that discipline. They force you to watch, to wait, to respect the market's decision instead of your own opinion. Do you see now how the hidden power of these levels isn't just in drawing lines on a chart, but in shaping the trader's mindset? It trains you to think in terms of probabilities, to respect the crowd without following it blindly, to balance conviction with flexibility. That's the edge. And without that edge, no strategy survives long. The power of support and resistance lies in patience, not prediction. That may sound simple, but in truth it's one of the hardest lessons a trader can ever learn. Most people come into this game with the wrong mindset. They want certainty. They want to be told exactly what will happen tomorrow, next week, or next month. They want to predict because prediction feels safe. It feels like control. But the market is a master at humbling anyone who tries to force certainty upon it. What you need instead is patience, the ability to wait for the market to show you what it's going to do at those critical levels, and the nerve to act only when the odds are clear enough. Think about it for a moment. What happens when a stock approaches a well-watched level of support or resistance? The crowd starts leaning in. Traders pile on with their opinions. Some say, it can't go any higher than this, while others insist, this breakout will run forever. At the same time, stop-loss orders build up on both sides. That price point becomes charged with emotion and money. Now, the impatient trader can't help himself. He guesses. He jumps in early, trying to front-run the move. Maybe he gets lucky once or twice, but more often than not, the market punishes him. Why? Because he's predicting instead of waiting. Patience, on the other hand, is about sitting still and observing the market's behavior at those levels. Does support hold with conviction, or do the bids vanish like smoke? Does resistance crumble under heavy buying, or does it repel the price and send it tumbling back? Those answers aren't found in guesses or hunches. They're revealed in the action itself, in the tape, in the character of the market. And to see them, you must wait. You must resist the urge to jump in before the evidence is clear. Let me ask you something. Have you ever noticed how the best moves often come right after the majority of traders have been shaken out? A stock breaks support, stops get triggered, the weak hands panic, and then suddenly it reverses and rockets higher. Or a stock pokes its head above resistance, tempts in the chasers, and then slams them with a reversal. If you were patient, if you waited to see the reaction after the break instead of predicting it, you'd be ready to spot the real move instead of being trapped in the false one. That's the power of patience. Prediction is intoxicating because it feeds the ego. You want to be right. You want to say, I called that breakout, or I knew it would bounce there. But trading isn't about being right, it's about making money. And making money consistently requires putting your capital to work only when the conditions are favorable. The market doesn't pay you for being early, it pays you for being correct at the right moment. That moment only shows itself with time, with observation, with patience. I've seen countless traders destroy themselves by overtrading at support and resistance. They buy too soon because they think the floor will hold. They sell too soon because they think the ceiling will cap the rally. And every time they're wrong, they dig a deeper hole. If they had simply waited to see the character of the move, they would have saved themselves from unnecessary losses. Isn't it ironic? Doing less often produces more in this business. The less you predict, the more you wait, the more your trades improve. Patience is also the foundation of wealth building through trading. Every large fortune made in the markets was made by sitting, not by jumping in and out every 5 minutes. When support proves itself and a trend emerges, the money comes to those who hold on with patience. When resistance finally gives way and a new leg of the move begins, the profits flow to those who resisted the temptation to bail too early. The crowd, driven by impatience, sells at the first sign of discomfort. The professional, armed with patience, waits for the market to clearly show a change before acting. That difference in mindset is the difference between giving your capital away and compounding it. Now, patience doesn't mean paralysis. It doesn't mean doing nothing forever. It means knowing when to do nothing and when to strike. It means you don't act because of boredom, but because the market gave you a reason. Have you ever caught yourself forcing a trade just because you hadn't taken one in a while? That's impatience disguised as activity. The professional understands that the waiting is part of the job. The real work is sitting in front of the tape, watching the crowd reveal itself at those key levels, and then moving only when the evidence demands it. There's also a deeper psychological benefit to patience. Every time you predict and lose, you chip away at your mental capital. You start second-guessing yourself. You lose trust in your ability to read the market. But when you're patient, when you let the market confirm your thesis before committing, you preserve that mental strength. You take fewer trades, but they're cleaner, clearer, and more confident. And that confidence compounds along with your capital. Support and resistance are perfect teachers of patience because they force you to wait for proof. A level may look obvious on a chart, but until you see how the market behaves there, you don't know if it will hold or break. If you're patient, you learn to spot the difference between a strong defense of support and a weak one, between a genuine breakout of resistance and a false one. Prediction blinds you to these details because you've already made up your mind. Patience keeps you open to whatever the market reveals. Let me ask you directly, do you want to be the trader who guesses or the one who observes? Do you want to gamble on your opinion or build wealth by letting the market prove itself to you? The hidden power of support and resistance is unlocked only by the latter choice. The lines themselves aren't magical. What makes them powerful is the discipline they demand from you. They're opportunities to practice patience in a world obsessed with prediction. And consider this: markets are designed to test your nerve. They move just enough to tempt you in, then whip back to shake you out. If you rely on prediction, you'll always fall for these traps. If you rely on patience, you'll sidestep them. You'll wait for the crowd to exhaust itself, for the false moves to play out, and then you'll take your shot when the path of least resistance is clear. That's when patience pays not because you knew what would happen, but because you waited to see what did happen. The irony is that the impatient trader thinks he's being active, but in reality, he's just feeding the market his money. The patient trader, on the other hand, appears inactive, sitting still while others scramble. But when the moment arrives, his action carries weight. He has the capital, the clarity, and the conviction to strike hard, and the results speak for themselves. So the lesson is clear: support and resistance aren't about predicting the future. They're about testing your ability to wait, to watch, to respect the market's verdict instead of forcing your own. That's where their hidden power lies. It isn't in the lines themselves, but in the patience they demand, and the discipline they build in the trader who respects them. Professional traders wait for confirmation. Amateurs act on first touch. That simple difference separates the few who build fortunes from the many who hand theirs away. An amateur looks at a chart, sees the price come down to support or rise up to resistance, and he jumps. He believes the market owes him a bounce or a reversal simply because the price touched a line he drew. He acts on contact. He doesn't wait to see whether the market agrees with his opinion. A professional, on the other hand, knows better. He knows that the market doesn't respect lines, it respects money and conviction. He waits to see which side has the stronger hand before putting his own money on the line. Think of how many times you've seen a stock poke its head through resistance only to collapse back below. That's the graveyard of amateurs. They buy the instant it touches or slightly breaches the line, thinking they've caught the breakout early. But because they didn't wait for confirmation, because they didn't watch how the stock behaved after breaking out, they end up holding the bag. The professional avoids this fate by demanding proof. He waits for the price not just to cross the line, but to hold above it, to attract volume, to show that buyers have truly taken control. That waiting makes all the difference. Do you see the psychology here? Acting on the first touch is driven by impatience and ego. The amateur wants to be first, wants to say he called it, wants the thrill of being right before everyone else. But the market doesn't pay for ego, it pays for discipline. The professional knows he doesn't need to be first. He needs to be on the right side when the odds are strongest, so he lets the market prove its intent. That's confirmation. That's the edge. Let me ask you something. When you've acted too quickly at support or resistance, how often did you get chopped up by false moves? Maybe the stock touched support and bounced for a few minutes, giving you hope, only to break down and keep falling. Or maybe it tapped resistance and pulled back just long enough to convince you the level would hold, then ripped higher without you. That whipsaw is the cost of acting without confirmation. Every premature trade is a tax paid to the market for your impatience. Professionals don't pay the tax because they know better than to confuse a touch with a true move. Confirmation comes in many forms. Sometimes it's the price holding above resistance for several sessions instead of just minutes. Sometimes it's volume swelling to show real participation. Sometimes it's the failure of a false move, where the market quickly reverses back through the level and reveals the trap. The point is, confirmation means waiting for behavior, not just price. The amateur looks at the number. The professional looks at the reaction, and that subtle difference changes everything. Now understand this clearly. Waiting for confirmation doesn't mean you'll never lose. Losses are part of the game. But by waiting, you filter out a mountain of bad trades that would have drained your account and your mind. The goal in trading isn't to win every time. It's to preserve your capital long enough to be present when the real move comes. Acting on first touch is death by 1,000 cuts. Waiting for confirmation is survival until opportunity. There's also a money management principle here. Amateurs who act on first touch take too many trades. Their accounts bleed from constant small losses. Professionals who wait for confirmation take fewer trades. Their accounts benefit from selectivity. And here's the irony, taking fewer trades usually leads to bigger profits, because you're only in the market when it matters most. Wouldn't you agree that it's better to hit one fat pitch than to swing at every ball thrown your way? Another layer to this is how confirmation reinforces discipline. Every time you force yourself to wait, you're building mental capital. You're proving to yourself that you can resist the crowd's urge to act impulsively. And when the confirmation finally comes, your entry has more weight because it's backed by evidence, not just hope. Amateurs burn out quickly because their confidence evaporates after a series of false starts. Professionals build confidence over time because their patience pays off in cleaner trades. Consider resistance as an example. When price touches resistance, amateurs often short immediately. They want to catch the top. But the professional asks, will sellers really defend this level, or will buyers overrun it? He waits. If the stock rejects resistance sharply, with heavy selling volume, that's confirmation. If it stalls, chops sideways, and then lifts higher, that's also information. It's telling him the sellers are weak. Either way, he isn't guessing. He's reading the tape, letting the market speak. Support works the same way. Amateurs buy the first dip into support, thinking it's a guaranteed floor. But floors break. A professional knows that. He waits to see if buyers step in with conviction. He looks for multiple tests, higher lows forming, or strong reversals. If support holds with energy, then he acts. If it breaks and collapses, he stays away or even goes short. Confirmation gave him clarity, while the amateur lost money clinging to a line. Do you notice the theme? It all comes back to patience. Acting on first touch is the opposite of patience. It's the illusion of control, the belief that drawing a line gives you an advantage. But those lines are only as strong as the market's behavior around them. Without confirmation, they're nothing but ink. The professional accepts that reality, and that acceptance is what keeps him in the game long enough to win. Here's something else worth thinking about. The market is designed to punish those who act on first touch. Why? Because the crowd always sees the same obvious levels. When price comes into support, stops are stacked underneath. When price presses against resistance, breakout buyers rush in. Smart money knows this. They use it. They trigger stops, shake out amateurs, and only then reveal the real move. Acting on first touch puts you in the crowd's trap. Waiting for confirmation keeps you aligned with the smart money. And don't underestimate the emotional relief that comes from trading with confirmation. Instead of sitting in constant doubt, will this bounce hold, or will it break? You enter with the reassurance that the market already answered the question. That reduces stress, and reduced stress means clearer thinking. Clear thinking is a professional's greatest weapon. So the real difference is not about drawing lines differently or having a secret indicator. It's about mindset. Amateurs think being early is the same as being smart. Professionals know being early is often the same as being wrong. Amateurs crave action, professionals crave clarity. Acting on first touch gives you action. Waiting for confirmation gives you clarity, and clarity is what pays. Support and resistance are not fixed lines, but psychological battlegrounds between buyers and sellers. That's the first truth most traders never really learn. They draw a neat horizontal line on a chart and convince themselves that the market must respect it like a wall, but the market doesn't obey ink on paper. What it obeys is money, fear, greed, and memory. These levels exist not because of geometry, but because thousands of traders, investors, and speculators all focus on them at once. turning them into zones of conflict. Imagine a stock that has climbed for weeks and finally hits a round number, say 50. It stalls. Traders hesitate. Why? Because 50 isn't just a number. It represents profit taking for those who bought lower, hesitation for those who think it's too high, and temptation for those who fear missing out. That stall becomes resistance. The next time the price climbs toward 50, everyone remembers what happened before. Sellers prepare to defend. Buyers hesitate again. Suddenly, it feels like 50 is a brick wall, but in reality, it's nothing more than a psychological battleground where opposing forces meet. Support works the same way. When a stock falls to a certain price and finds buyers, that price becomes etched in memory as a floor. Traders say, last time it bounced here, maybe it will again. Buyers camp there with orders. Sellers start doubting their conviction. The next approach to that level is loaded with emotion. But just as with resistance, it isn't the line itself that matters, it's the behavior of the crowd at that line. If buyers step up, support holds. If fear overwhelms them, the floor collapses. It's always a fight, never a certainty. Let me ask you something. How many times have you seen a price level broken only to watch the stock reverse back, as if mocking everyone who jumped in? That's the essence of this battleground idea. The amateurs believe the line is ironclad. The professionals know it's a zone of war where one side will test, the other will defend, and only when the outcome is clear can you act with confidence. The line doesn't decide, the crowd does. This is why treating support and resistance as exact points leads to so much frustration. The market doesn't move in perfect straight lines. It overshoots. It shakes out. It wicks above resistance and below support to test conviction. That's not random noise. That's the battleground in action, with one side probing for weakness and the other trying to hold ground. Those false breaks are nothing more than scouts in a war, testing defenses. If you understand that, you stop being fooled by every tick and start reading the story behind the moves. Now, here's where the psychology deepens. Every time a support level holds, confidence builds. More traders believe in it, more orders stack there. That makes the battleground stronger for a while. But paradoxically, the more a level is tested, the more fragile it becomes. Think of it like a fortress under siege. Each attack weakens the wall. Eventually, the defenders tire, supplies run low, and one final push breaks through. When that happens, the fall is sharp because the crowd that trusted the support suddenly realizes it was betrayed. Panic selling cascades. That's the hidden danger of treating support as unbreakable instead of as a contested zone. Resistance plays out in the same way. The more times a stock bangs against the ceiling, the more tempting it becomes to believe it will never break through. Yet each test absorbs supply from sellers. Each attack chews through more offers. Eventually, the wall gives way, and the breakout is violent because the sellers who relied on resistance are now trapped. Add in the short sellers covering their positions, and you have the fuel for a sharp rally. Again, it's the battleground principle at work. Confidence builds, then collapses, and the losing side's retreat fuels the winning side's victory. Do you notice how these levels aren't just technical but deeply human? Support and resistance are the footprints of crowd psychology, their fear and greed written into price. At support, buyers fear missing a bargain and sellers fear pressing their luck. At resistance, buyers fear overpaying and sellers fear losing their profits. Those fears and hopes collide at every test. That's why no indicator is needed to draw the lines. The crowd shows you where they are by how it reacts. Let me ask directly, do you really believe that a market falls exactly to the same price and reverses because of magic? Or is it more likely that human beings, remembering the past, cluster their decisions around those prices? That's the battleground. That's why these levels work. Not because they're precise, but because they concentrate the emotions and orders of the crowd into narrow zones. There's also a wealth-building principle tied to this idea. Most traders lose because they expect certainty. They believe support must hold or resistance must reject. When they're wrong, they get whipsawed, frustrated, and reckless. The professional, understanding the battleground, sees it differently. He waits. He watches the battle unfold. He doesn't need to predict. He only needs to recognize when one side has clearly gained the upper hand. That's when he acts. That patience, that ability to let the fight play out, is what preserves capital and positions him for the big moves when they come. Think about what happens when support flips to resistance or resistance flips to support. That's the battleground shifting sides. A stock falls through a floor. Later, when it rallies back to that level, the same traders who once saw it as support now treat it as a ceiling. Why? Because they were burned. They remember buying there and losing money. They're eager to sell now just to escape even. That memory transforms the battleground, turning defenders into attackers. The opposite happens when resistance breaks and later acts as support. The crowd's psychology flips, and the battleground shifts roles. Volume is another clue to the ferocity of the battle. When price nears support with heavy volume and holds, that's strong buying conviction. When it fails on heavy volume, that's a rout. At resistance, heavy volume on a breakout tells you the attackers are overwhelming the defense. Light volume, and it may be nothing but a fint. Professionals use volume as a way of gauging how strong each army is at the battleground.